Right, I think in the interest of time, we should get started. So welcome everyone. Thank you very much for joining us for our investment webinar covering the first quarter of this year. To provide you with a brief summary of what will be discussed today. So we'll be doing a brief recap of the first quarter and the various things that have been happening during the course of that period. We will then be going on to discuss some of the forces that have been driving markets over that time, such as inflation, central banks, and of course, the terrible events that we've witnessed over in Ukraine. We'll then go to our thoughts moving forwards and finally a summary. Unfortunately today, Tommy was not able to join us. Tommy, my colleague, normally hosts these with myself. He was unable to make it, so it'll just be me today. If in terms of questions, if you would like to ask any questions throughout the presentation, you can do that via the drop down, which is either at the bottom of your screen or the top. There is a Q&A box. If you please type your question in there, and I'll try my best to answer it at the end of the presentation. Okay. We can move on to the recap of the quarter. So the markets continue to be dominated by macroeconomic themes or high-level themes, and that led to a heightened level of volatility across multiple markets and asset classes. There were two main themes that were driving that over the quarter. And it was almost split sort of two halves, where almost from the get-go in the first week of January, we saw markets beginning to fall, the equity market specifically as well, due to the central banks changing their stance and the way they were viewing inflation. And then we saw a brief respite of that towards the middle of February before Russia invaded Ukraine on the 24th of February, and that then led to renewed volatility levels. And the effects of that are actually linked to what the central banks have been saying, which we'll come on to shortly. What's become very clear is, and this is something we've talked about in the past in our previous webinar, is that the central banks have become more hawkish, which basically means they are more likely to be raising interest rates for the foreseeable future, largely driven by the pickup in inflation that we've seen across many aspects of life. And that again was, and then of course the Ukrainian invasion, which led to renewed inflationary pressures, mainly because of the disruption in supply with regards to oil, natural gas, wheat, corn, and other foods and commodities, specifically really within Europe, but of course across other parts of the world as well. If we can maybe just touch briefly on some performance figures over the quarter. So it was a difficult period for equity markets in general, and most markets fell at least 10%. As far as the portfolios go, of course, we operate several portfolios across different risk buckets. So if we go from the lowest risk, we ended the quarter at something between -2 to -3%. At the higher risk end, you're down probably -6 to -8%, depending on what portfolio you are. So just to give you a bit of a range. We did see some historical things happen with the quarter. So for example, the price of nickel went up dramatically over a 2-day period. It went up over 250%, which led to the London Metal Exchange being forced to suspend trading. So there have been several instances like that where commodity prices and other things have gone up quite dramatically off the back of, well, they were already going up, but off the back of the Ukrainian war, those issues have been exacerbated. Maybe something else worth mentioning is that, which may be a slight surprise, is that the US stock markets specifically actually stopped falling on the day of the invasion and have been rising ever since. If we just drill down a little bit more into some of these themes. So as we're all aware, and I've mentioned many times in the past, year-on-year inflation data has continued to rise as measured by CPI. So over in the US, it's almost at 8% now, year on year. Here in the UK, it's at 6.2%. But given the invasion of Ukraine and the results and pickup in commodity prices, we are expecting that number to go higher in the short term as the cost of living gets squeezed. Yeah, and I've just touched on that the Ukraine invasion has exacerbated some of the inflationary issues. And just back to my point earlier, you know, by mid-February, I think there was a broad expectation that some of these inflation pressures will begin to ease and the markets were starting to price that in. So yeah, the invasion did definitely renew that and maybe talk about that a bit more in terms of markets. So what we saw sort of first week of January and certainly coming into the new year was the markets beginning to price in higher interest rates. And if we talk about the US specifically, because of course they are a much bigger player on the global stage and affect the whole world effectively. What we began to saw was the markets pricing in higher interest rates in America. And this was a very, very fast move. So we're talking a couple of months and the markets are pricing in a further 2% of interest rate hikes over in America. And to put that into perspective, I mean, that's quite an unprecedented move. I don't think we've seen that many times, if ever, in the past. So the markets were very quick to respond to that. And what that also does is, because when you have interest rates going up, you have the yield on a bond also going up. And when bond yields go up, that actually has the opposite impact on bond prices in that they begin to fall. So the bond markets have actually had a very, very tough time this quarter. We have, of course, seen higher commodity prices, as I mentioned. That was a feature that we saw last year due to mainly around supply chain constraints and other factors. But this year it's been led more by the situation in Ukraine. The way the bond yields moved higher into this year and certainly during January led to quite a lot of volatility in the markets, and it affected some parts more than others, and specifically those that have higher growth potentials or have exhibited higher growth rates over prolonged periods of time. So you typically see those companies in the technology sector, for example, or any company that has a relatively stable earnings growth and cash flow projections into the future. Those are the sorts of companies that came under pressure, and it's because of the way that the valuations of those companies are calculated. They are more sensitive to changes in interest rates. So as interest rates go up, or the expectation for interest rates go up, that impacts their valuations more than it would with other companies. And so that's certainly something that we've seen over the course of the quarter. As I mentioned already, central banks are certainly more hawkish than they have been. And again, if we take the US Federal Reserve as an example, by the end of January, perhaps early February, the markets were pricing in the US Federal Reserve potentially raising interest rates by about 7 times over the course of the year, which is quite aggressive, quite a big move. By mid-February, the markets began to change that view and actually lower what the expectation was for interest rates. So they thought that it had changed to price in perhaps 4 or 5 interest rates by the end of the year, as opposed to 7. So there was a bit of a respite going on in the markets. And then, as I mentioned, once the Ukraine invasion started, and all of the inflationary pressures were renewed, that led to markets then pricing in, or going back to the original view, which was to for more interest rates, 7, but actually that's now moved to 9. So quite a lot of change going on over the course of the quarter, and as I mentioned, that's led to a fair amount of volatility. The other part maybe worth mentioning is that the central banks, and this by the way includes the Bank of England and others, the European Central Bank, they're all sort of in a similar boat, and that also includes this idea that the stimulus that we've seen since the pandemic, which effectively helped various economies and the world effectively come out of that economic problem that we had, and that stimulus has been is now going to come down and be reduced moving forwards, because growth has recovered significantly, and if they continue that level of stimulus and support, then we will probably continue to have inflationary pressures and issues which make it worse. So they are scaling that back to try and temper future inflation. So over this quarter, given it's been very eventful and volatile, we have been very, very busy over the quarter, really from the first week of January onwards. Depending on which portfolio you're in, I think some of the higher risk portfolios that had investments that were more sensitive to interest rate changes, they were changed more so than some of the others. So we were very quick to get out of some of that, some of those investments, and invest in areas such as funds that invest in companies that are more sort of dividend focused, so more defensive, more stable type companies. They tend to be quite useful during volatile periods in defending. That definitely helped. We've also changed the nature of some of our healthcare exposures. So we opted for larger cap, more established, more stable businesses. Again, healthcare is a sector that tends to be quite defensive. The large cap parts of the healthcare tend to be very defensive over such periods. So we did make a change there. Again, that's helped us. And there have been several other things depending on which portfolio you're in. Some were affected more than others, but yeah, we've been very active. So far, the changes have been beneficial for portfolios, and we will touch on what we're thinking about doing next. So moving forwards, we think that given there's a lot of focus on the expected path of what the central banks will be doing and raising interest rates, it's more than likely that what they do will continue to dominate markets. So it won't be so much a case of markets focusing on how companies are performing and their earning stability and, you know, etc. It will be more about what the central banks are doing. Despite everything that's happened, you know, there's been a lot of pessimism or negativity of the quarter. Quite often, when you see that, that's normally the point at which we see markets turn, and that's certainly the case in the US, when you would think that on the day of the invasion could possibly not have been the bottom of the falls of the US stock market. They actually ended up, that was the day that they ended up bottoming, and they have been moving higher ever since. So quite often, when there's lots of pessimism around, lots of negativity, that's quite often the turning point in markets. And so we are expecting higher levels of volatility given all of the uncertainty around central banks, but we expect a general upward move towards the end of the year, but it will be probably more volatile than it has been in the past. Something that we've talked about again several times, and we are continuing to see this, is gyrations between different parts of the stock market. So those that, as I mentioned, you know, who have higher growth rates in terms of their earnings, such as technology companies, versus businesses that are more geared into the economy and are perhaps a bit more cyclical, such as retailers, such as energy companies, and also anything of that nature. They are sort of put in two separate camps, if you like, termed as growth and value. And what we have seen is that because the environment, specifically around inflation, has been quite has been trending upwards, that's created a lot of volatility between these two camps, which is, you don't always see that, but has been the case over the last 12 months or so, where you'll get periods where growth does quite well, and then other periods where value does quite well. We expect that to continue. This year, growth has not done as well so far versus value. At some stage that will turn, and we've actually, to be honest, we have actually seen a reasonable bounce in markets over the course of March. Actually quite a big bounce in some portfolios. That was largely driven by the growth parts of the portfolios and the markets. And so we're going to keep seeing these gyrations between them. And the reason I mention it is because this does tie into something that we're thinking about doing moving forwards. So we go into actions here. The first point worth mentioning is as I mentioned earlier, about bonds and bond yields. This is something that we have been worried about for quite a long time. We've been worried about this probably since 2020, actually. And we have been steadily increasing our exposure to hedge funds and selling bonds. And you know, those parts of the market, especially bonds, have traditionally been seen as a way to diversify your portfolio of equities. We were worried that that may not be the case moving forwards, and so we will opt for a different source of diversification, largely via hedge funds, and we've also used gold to some extent for that as well. Given that the bond markets have had a really tough time last year, and especially this year, they've been incredibly volatile and have done very poorly. We are going to maintain this preference of hedge funds over bonds, and we are looking to enhance our exposures to those different alternatives over the course of the year. Now, the second part is more passive equity exposures. For those people who are in our active portfolios, I mentioned that we're seeing lots of gyration between these growth and value camps. When you invest in a sort of broad stock markets, you're not really going for a specific fund. The stock markets tend to be agnostic to those movements and gyration between those different camps, because they provide exposure to all of those areas combined. So because we think that we are more than likely to continue seeing these gyrations, and therefore we're probably going to continue to see quite a lot of volatility around, we have been and will continue to be opting for more passive exposure. So this will be via index funds or ETFs, and all they do is they just track the performance of a broad market. So for example, the FTSE All Share. We have initiated very recently an investment in a product run by HSBC, and all it does, it just tracks the performance of the FTSE All Share. For those who are in our ETF models, you already have that exposure for the actives. This is something new, and this is just to diversify the different camps that we have in the portfolios, the growth and value, just try to dampen that down a bit. And what we hope is that by doing that, there'll be two benefits. One is obviously your overall portfolio fees will come down, but secondly, the volatility levels should also come down as well. So we've already done some this year. We've done some very recently. Some of you would have had a fund switch notice for those who are on the advisory service, and we expect to continue to do those sorts of things over the coming months. So in summary, markets are likely to be continued to driven by central bank action and the future path of interest rates. We still think that markets will be higher by the year end, although with slightly higher levels of volatility. And as I mentioned, we are likely to increase more exposure to broader markets within the active portfolios over the coming months, just to sort of dampen down the volatility a little bit. So that brings me to the end of my presentation. Please feel free to ask any questions at all. I'm more than happy to take any and try my best to answer them. Right, looks like we've got one here. So question is, what has the impact of the Ukraine invasion had on our portfolios? So the first half of the quarter, as I mentioned, was dominated by what central banks were doing with regards to interest rates, or what they were saying, and how the markets were then reacting to that news and pricing in future expectations. That impacted the US stock markets more so than it did any others, because the US Federal Reserve were perhaps more negative than others. However, once the invasion started, I think it's fair to say that that was much more of a European and UK-centric problem, given their proximity to Ukraine, and secondly, given their dependence on Ukraine and Russia for obviously energy and food. So what we ended up seeing is the US stock markets recovering from that point forwards, but the UK and European markets, and to some extent the Asian markets, coming under more pressure after that. Now, given that most of our portfolios are, sorry, not most, all portfolios are globally focused, we don't have that, which have very little exposure directly to Europe. We have a reasonable exposure to Asia and the UK, but in terms of the overall, we're probably more skewed to other regions outside of the three I've just mentioned. And so in the end, the invasion didn't really have much of an impact on portfolios. We probably had one slight move lower on the 8th of March. And then ever since then, we've been recovering. So far, it's actually been okay, relatively contained. And really, to be honest, we've actually been recovering and rallying over the course of most of March, to be honest. Right. Next question here is why are bonds performed so poorly? So as I mentioned earlier, that when you have interest rates going up, in short, the impact that has is that bond yields go up, and that has the opposite effect on bond prices. So when bond prices fall, bond yields go up. Now, this is something, as I mentioned, that we've been worried about for quite a long time, and we weren't sure that bonds were going to be able to defend us and act as a diversifier, as they have done for the past 3 decades, because of this changing backdrop of higher inflation, which we haven't seen for quite a long period of time. So that's basically why we began to shift away from bonds as much as possible. And some portfolios actually have no bonds at all. However, having said that, the bonds that we do have or have maintained have actually done relatively okay. And one in particular, which is I have mentioned in the past, which is a US inflation ETF. So it invests in a variety of inflation products that we've ended up buying at the end of 2020 for several portfolios, not all, but several. That had that delivered 15% for us last year, which is an incredible return for a bond product. And this year, given that, if you look at a basket of gilts, UK gilts. They're down 8, 9%, maybe 10% this year, with a lot of volatility. And that particular ETF is actually flat this year. So the areas that we are exposed to have been relatively good, and where we were worried, we've been selling, especially probably a year ago now, and maintained our exposure to different types of hedge funds, which thankfully in aggregate have actually done quite well for us, and have significantly outperformed a portfolio of bonds, effectively. I've got a question here about energy prices. Do you think they're going to plateau or rise further? I think answering anything around the energy costs or other commodities is probably quite difficult at the moment, given that the conflict is ongoing. Yes, the Russians have retreated from the Kiev region, and other areas have moved east, but we don't really know what that means for, let's say, 1 to 2 months' time. Clearly, we've had a huge pickup in energy prices, so that may imply that short-term, markets perhaps got a little ahead of themselves in terms of commodity prices. But I think it's probably still quite early to say whether we're going to see a plateau or not just yet. It really does depend on what happens with Russia, how quickly countries move away from the dependence on Russian energy, if that happens, etc. So it's probably quite difficult to say right now, I think. Next question I've got is about sustainable stocks and how they performed over this quarter. So, as many of you are aware, we have a portfolio dedicated to sustainable investing. The portfolio naturally gravitates towards companies which score well on ESG metrics. So, and again, because of that bias, it does go towards specific sectors. So technology is one, healthcare is another, and renewable energy. So they're the three, I would say, key areas that the portfolio gravitates towards, because they are the areas that score well on ESG metrics. Now, based on my comments earlier about which types of companies have come under pressure this year because of the rise in interest rates, unfortunately, they are the exact areas that have, except for healthcare, that have come under pressure. So, so technology companies, yeah, they've struggled. Renewable energy businesses, up until post the Ukraine invasion, came under pressure as well. So that unfortunately meant that the portfolio had a tough time over the quarter, and we are currently looking at addressing that in a variety of ways, whilst trying to maintain true to the portfolio's aim of investing as sustainably as possible. But yeah, it's come, that portfolio has been in the crosshairs a little bit, just with regards to the natural exposures that it has. Another. Yeah, got that one. We've got another one here on credit markets and what the view is. So just for everyone's benefit, that the credit market is a market looking at how companies are performing with regards to their debt. So obviously lots of companies borrow money. There is a market for that, so it's not just, we have the equity market, we also have the bond market, the credit market, and that quite often is an important gauge for future expectations. So normally when you see defaults starting to rise on companies and outstanding loans, that can signal that there are concerns ahead, and that maybe things are starting to sort of roll over, and maybe an economic slowdown is coming, or recessions or whatever. However, at the moment, the credit markets are absolutely intact. We've not seen any change at all, despite all of the sort of negativity around the backdrop. So at the moment, the corporate landscape seems to be intact. And yes, certain businesses will be coming under pressure, those that are energy intensive because of the rise in input costs and energy costs. But more broadly speaking, we haven't seen any change to default rates at the moment. So therefore, the economic cycle still seems fine for now. One more question I think I've got here is about inflation again and strategies around that. I've already touched on some ETFs that we have specifically around US inflation and a specific ETF that we had that's actually done very well for us. We also have gold in a number of portfolios, a number of our core models, both active and passive, as physical gold. We expect gold to continue to recover from what's been a fairly difficult period for gold over the last 15 months or so. And recently it started to pick up again. So we expect gold to continue. And on the equity front, that inflation, higher inflation does bring about more volatility. And so we brought in, as I mentioned earlier, some things within the equity parts of the portfolio, such as healthcare, which are much more defensive. Some of our portfolios have infrastructure, which again tends to do quite well in these environments. We've got some exposure there, and we've got some exposure to sort of global dividend paying type businesses as well. So again, more defensive. So there's definitely been a shift, and some of our non-equity holdings have also been very good for us. And as I mentioned, that we were looking for the core active model to try and move increasingly towards this broader market exposure. That just helps to dial down some of those exposures or sort of biases that we have in the portfolios. Got one question here. So got a question about China and the COVID issues that they're having over there. Shanghai, as we know, has been in a lockdown for about a week. Question is, do you see this impacting our growth portfolio holdings, which is around 50% US and UK and Asia? So in the growth portfolio specifically, the exposure to Asia at the moment is about 17%. Of that, specifically to China, the exposure is probably about 30 to 40% of that number. So therefore, I think the actual exposure is quite small directly. There are concerns that the lockdowns over there may lead to knock-on effects in other regions, which may exacerbate supply chain problems, for example, and therefore inflationary pressures. It may lead to growth concerns. So that is something that's very valid. It's unfolding as we speak. I believe there was another city that will go into some sort of lockdown more from the school's perspective tomorrow. So that's an unfolding situation. Yes, that could have knock-on impacts and effects in a variety of ways. That's not necessarily clear, but in terms of our actual direct exposure, it's not. We don't have a huge amount, and I think that we're sufficiently diversified across the other part of the portfolio that should be able to mitigate those issues. But I think with all of these things that we're seeing at the moment, market issues and concerns come from time to time, and we've seen quite a number of these actually in the recent past, clearly with COVID in 2020, and we had several different issues going on last year, and of course this year has also been quite tricky. So these things come and go, and China, for example, and the COVID issues will be dealt with at some point, and we'll move on, and the markets will begin to worry about something else. So what we urge people always is to try and remain focused on the long term. The markets are in a structural long-term advance, which you can see on any sort of very long-term chart, and we will have these bumps along the road from time to time, as we're seeing right now. So yeah, we do urge you to remain focused on the term. We do expect markets to be higher by the end of the year, maybe a bit of a volatile journey, but we still expect that to be the case. It looks like I've run out of questions, and so in the interest of time, we'll wrap it up. If you have any follow-up questions, if anything comes to mind, please feel free to drop me an email and I'll come back to you as soon as I can. Thank you very much for joining us. Take care.